I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service. Ted, what's the highlight of the past couple of weeks for you?
Well, I think the major development in the Canadian market is what Bill Morneau announced on Monday, and that is some fairly significant changes to the housing market in Canada, both in terms of mortgage subsidies, which have been going on for years, that is not so obvious, but there's been some big changes to mortgage subsidies in Canada, and also to the tax code. And now, I don't expect this isn't exactly an atomic bomb that's hit the housing market, but it's not a pea shooter either. We've had I think the finance departments, they brought out some bazookas here, and it's going to have an impact in what they propose. And basically, he's come down with three measures. One is to apply a stress test for insured mortgages. So if you don't have 20% down, you have to get a mortgage insurance. So that's going to be tougher to get. And they've actually quite remarkably have almost done a phantom interest rate increase, because now instead of anyone applying for mortgage insurance getting tested on market rates, they're getting tested on the posted Bank of Canada rate, which is about 2% higher. So while it won't impact the mortgage that you're paying, it does impact how much you can qualify for insurance. So that's a big deal. Now, the other insurance-related subsidy that's been impacted is mortgage portfolio insurance, which most people are not familiar with. And I have to admit, it's not something that was on top of my head until I read the documents from the finance department. But basically, for all those loans, mortgages that banks have on the books with people who put down more than 20%, and there's a lot of mortgages in Canada that have more than 20% down, they can still get taxpayer help in packaging up these mortgages and basically selling them off, and they're able to qualify for a CMHC sponsored pooling service, basically, and back service, and that allows not only banks to lower their risk, but to make the mortgage market all that more liquid. So that has helped grease the wheels over the past few years. Well, that's now facing stricter eligibility requirements. The banks have to approach those mortgages just like they're approaching a mortgage that's going to be insured under 20%. So that's a big deal. And then the final big deal was a tax measure where they're tightening the rules around what a principal residence is. So for people who have been speculating in the condo market and even the single-family home market, that's going to be a big deal, because there's tighter rules in terms of what you have to report on what qualifies as income and what qualifies for the exemption. So these three bazookas will likely have an impact. We're now going to find out how much of an impact.
Well, of course, when you wonder who qualifies for these mortgages, the most expensive property sold $31 million worth to Peter Brown. That property was bought by a so-called student.
And if I'm not mistaken, it also had a mortgage, and it'd be interesting to know if that mortgage ended up in this mortgage pool that was backed by Canada Mortgage and Housing. So, at least we're getting to learn a lot about what the inner secrets of the Canadian mortgage market and housing market. And one thing that is abundantly clear is how extensively it's been subsidized by the taxpayer. So these subsidies are starting to be peeled away. It will have an impact. The question is how much. Now, I can tell you today, the day after the announcement, we're seeing some mortgage related finance companies on the TSX still under some pressure. In our Canadian Insider Index, which tracks 50 growth and value stocks in Canada preferred by insiders, we have two lenders that are involved in the mortgage area. One is Equitable Group, and the other is First National. And they're both of those stocks are feeling some selling pressure today. So the market is saying these measures are going to have an impact. So now we'll have to see how it plays out literally on the street.
What about companies that give home equity loans? How are they affected by this? Or are they?
Well, a lot will depend on the vibrancy of the market. The home equity loan business will grow so long as equity values in homes are growing. If that is peaked out, I expect the home equity line of credit business has also peaked out.
So not so much a fine walk in the park, as one of the ads say.
Well, we're all going to be interested to see how this works out. Now, what is interesting though is that the Finance Department has gone a step further, actually, and is almost doing what we would call forward guidance in the housing market, saying, if these measures don't cool it, we've got something else up our sleeve that we're going to seriously consider, and that is maybe require banks to basically incur a deductible on these mortgage insurance. So basically, just like your car, when you go to renew your insurance on your car, your broker always asks you, how much deductible do you want? Well, right now, the banks and people getting mortgages, insurance, don't have any deductible. Well, that could all change, and that would definitely push up the cost of mortgages. Unequivocally, that would push up the cost of mortgages. So, the government's really signaling that they're serious, and it's going to change behavior. And, we will see how much. And, so we've really had a 1-2 punch here, Jim, in the Vancouver housing market. We've had the foreign tax that was brought in the summer, and now we've got this bazooka action by Ottawa. So it's definitely a changed environment, and we will see if the money still keeps flowing into the property market. But, UBS came out last week showing that Vancouver was the riskiest market in the world. Eventually, these measures are going to have an impact, and basically fundamentals are eventually going to have an impact, unless you're prepared to turn your city into a city of real estate speculators, and that is not going to, well, I shouldn't say it's not going to happen, but with the foreign tax and now these tighter measures by Ottawa, it's getting harder and harder to treat Vancouver housing as to borrow a phrase from an economist in Hong Kong, Andy Shea. It's getting harder for speculators to treat Vancouver housing as gambling chips at the casino.
Now, people who had homes at the lower end of the spectrum, are they affected much by these moves?
They will be, absolutely, because the whole idea here is to tighten the conditions across the market. So, if you have 20% down and you're going to not need mortgage insurance directly on your house, the bank might have thought it was going to put your mortgage in a pool. So it's going to have to test you as well on those measures, and you may not qualify for as much as you like. So it is going to have an impact right across the board for sure.
It's going to make it harder for first-time home buyers, isn't it?
It's gonna make it harder for everyone, and I mean that's the point, though. And people are now living in a time where they've seen rising housing prices, especially young people, and if there's a perception that's been built in that it's a guaranteed one-way street, that there's no risk and property values only go up, it's important for first-time home buyers to understand the risks and that not to be anchored in the experience of the last few years where they hear about their buddies, oh, my house has gone up, I just bought it last year and it's already up 200,000, 300,000, 400,000. That's not normal. And taking a more cautious and perhaps waiting a bit longer to buy that first home may not be such a bad thing.
Well, real estate consultant Ross Kay has told us in the past couple of weeks that homes that perhaps were worth 1.4 to 1.8 could actually tumble back to the 500s.
Well, we'll have to see. I think research, we look at markets, but primarily the equity markets. But, all markets do have some common characteristics, and that is they usually, over time, retreat down back to fundamentals, but that has been harder since the great financial crisis because you have people like Stephen Polo's interfering with the market and destroying proper price signals. And, of course, he's a bit player in the whole central bank manipulation game. You've got Mario Draghi and Janet Yellen, who are much bigger players. And then, of course, there's Japan, which is kind of a game all to itself. So there's some major forces that have been really making a lot of those long historic principles of market dynamics stall out here. But they will return. The question is when. And, we're probably closer to them returning than this game, starting, which, was back in 2009. So we'll just have to see how far the correction is. But, so long as interest rates are at these ridiculously low levels, there is going to be underlying support to the housing market. So, with interest rate, overnight rates at under 1%, I would be surprised if there is a significant pullback in the Vancouver market without an increase in long-term rates. I mean, if long-term 5-year rates start to move up globally, it's a different story. But you have the Bank of Canada, who seems to be, we have a major risk here, Jim, that Stephen Polo's is going to totally negate 15% foreign tax by driving down the Canadian dollar 15%. I mean, he loves a lower currency. I mean, this guy, as soon as he got on the job, thought, all our problems would be solved by destroying the purchasing power of the Canadian dollar. I mean, that's the type of person who's in charge of the central bank, that wants to lower the dollar to boost exports. And, this is the reality that we're living in, that we have a central bank that likes a low currency, and that could definitely, boost housing prices by making making the prices cheaper for foreigners than domestically. So, we'll have to see how it plays out. If the Canadian dollar gets down to 65 cents, then this 15% foreign tax will basically be negated.
Does this mean we're going to be looking at $8 cauliflower again this winter?
Oh, not necessarily. I mean, we don't know where the currency is going to go. It's not a prediction that the Canadian dollar is going down to 65 cents. It depends what happens to oil prices and, what else is going around in the world. Just because the Bank of Canada may want a lower currency, that doesn't mean they're going to get it. I hope they don't get it. I hope the Canadian dollar stays stable. or strengthens a little bit because that makes us richer as a nation. It doesn't mean, it should go back to, 90 cents, but having a collapsing dollar is not just not in the interest of the average Canadian.
We'll have more with Ted Dixon right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Ted Dixon. Ted, of course, the Canuck buck depends so much on the value of oil. What's happening in the oil patch?
Well, we had OPEC agree late in September that they should cut production, and this has resulted in a spike up in the oil price. Now, the West Texas oil price has not yet touched $50 again, at least if not for very long. Now, it may get there, just based off of momentum, because it seems like you've had a sentiment shift among speculators in the market that the oil price has found the bottom. We'll have to see. Nothing has changed yet in the oil fields in OPEC. They've agreed on a framework to meet again in the end of November to, if everything gets agreed upon, to cut production about up to 700,000 barrels a day, and there's still a lot of road between now and the end of November to cover. So we'll see if an agreement amongst all these nations is worked out, and then if they actually adhere to the production cuts. So I think there's a lot of what ifs in this scenario. Markets have taken it as a positive outcome for the oil price, but I can tell you that in terms of what we track amongst Canadian insiders, they've been picking up their selling here, and in fact, we're seeing more selling now than we saw at the height of the oil boom in 2014, which is very odd. So insiders in the oil patch are taking advantage of this rally to take some profits, and they're taking them in such large amounts that it leads us to have some caution here that this optimism may be a little early, and that we still may have some hard work in the oil patch to do before we really kind of get back onto a sustainable path to higher prices.
Europe measures inflation differently than we do in Canada and the U.S. What do those figures indicate?
Well, what I like to do is track U.S. inflation based off of the way the Europeans calculate it. And the reason why I like to do that is because we always hear in the media about how, the Fed is tightening and the ECB is loosening, and it's because there's huge deflation in Europe, and in the U.S. Inflation's much higher. Well, when you actually compare it apples to apples, guess what? That's not the case. In fact, you have to kind of get out your magnifying glass, because when you look at how the two compare based off of what's called the harmonized index of consumer prices, in fact, the Eurozone has higher inflation than the U.S. And why is that? Well, basically, this harmonized approach to consumer prices doesn't include housing costs, rents, because basically the idea is that it's very hard to measure properly housing costs, and in the U.S. they have a very kind of odd way of doing it. They look at owner equivalent rents, which is a theoretical approach to measuring housing costs. It doesn't always provide you with the results that you think you're going to get. So Europeans would say we strip that out. And when you look at it that way, actually Europe has higher inflation, but they're both under 1%, and so and they're closer to zero than 1%. So inflation is still very low in both areas, but all these headlines you hear about how how worse off Europe is compared to the U.S. Well, pick your benchmarks accordingly, but there's some data out there that suggests that's just not the case, that the two are basically pretty much neck and neck.
How does that affect the markets here? I just see the London FTSE has hit a record high, the FTSE 100. Does that mean that London's going to bomb out now, or is that good news for the UK economy?
Well, it's good news for the UK stock market. The FTSE 250, which is primarily domestically focused, hit an all-time high, and the FTSE major benchmark itself was flirting with, I believe, all-time highs. So, what's going on? Well, the currency's tanking. It's at multi-decade lows. So, as a foreign investor, you may not be feeling the love as much as if you're a domestic investor in England, where you're based in pounds, and all you see is the FTSE up. If you had invested your Canadian dollars into the FTSE, well, you would have to deal with the depreciation of the pound. So you wouldn't have seen the same sort of gains. So we'll have to see how. Right now, the flavor of the month is to badmouth the UK economy because of Brexit, and so the pound is being sold. But domestically within England, the markets are telling you, hey, well, maybe this Brexit idea isn't that bad after all.
Ted, thank you so much for chatting with us.
It's great to be here. Have a good day.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Questions can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.